Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. Abel Pacheco here, the host of Five Talents Podcast. We are extremely excited to have you today. We have an amazing guest, Mr. Brandon Hall. Brandon, thank you very much for joining.
Thanks for having me on, Abel. I appreciate it.
Yeah, man. I'm sincerely appreciative of just having you as a guest. I was referred to you by another investor and partner of mine who trusts you highly, and he goes, you absolutely need to interview Brandon. He's a CPA, he's a national speaker. He's the founder of CEO and founder and CEO of the Real Estate CPA. So anyways, he was going through all your background, and he goes, he works with real estate investors. He does syndications. He helps with private equity funds to optimize tax positions. He went on and on and on about, I guess, you personally giving some really good advice. So man, I'm super happy you're here.
Well, I appreciate the intro. Yeah, I'm happy to talk through and provide some advice to your listeners.
Yeah. And for those that don't know a little bit about Brandon, just to give you some more background on why you should get a pen and a piece of paper at some point. If you're driving, that's okay. When you get back to the house, rewind the episode. But you've worked at PricewaterhouseCoopers, you worked at Ernst & Young prior to launching your own CPA firm, right?
Yeah.
And so a lot of years in that area. And then your own CPA firm, it's Hall CPA PLLC, the real estate CPA, yes?
Yeah, so the firm name is Hall CPA PLLC, but we've branded ourselves as the Real Estate CPA. And that was just a decision that I made early on when I was kind of launching it, was just to niche in real estate and just stick to real estate no matter what. And it's turned out to be a really good decision. But yeah, so I figured, what are people searching online if they're looking for a CPA? Like if I'm a real estate investor, what am I going to search online? I'm probably going to type in Real Estate CPA. So I'll just go ahead and buy that domain name, and we'll just brand ourselves as the Real Estate CPA. It's worked pretty well.
I think it's a smart move. When you niche down, we've heard if you try to reach too many people with a broad message, you really don't, end up hitting the mark. But if you niche down into people that you think can really, really benefit from your services, you're going to deliver amazing value, and those people will refer others, just like I was referred to you. So it makes perfect sense.
And service professionals too. I think it's important to niche. I've done a couple of these like speaking and podcast engagements for other CPA firms. And I think it's really important to niche down, because when you niche, you see the same thing over and over and over again. You start to learn the minute details of how different strategies work. And you can just blow other people out of the water, the generalists that don't get it, or they're providing bad advice. You can be the saving grace for a lot of clients, especially if you catch it early enough before they've done too much damage. So it's good. But like on the flip side, I'm not going to go and compete in the restaurant space, at least not today, because I know very little about the restaurant space. So if we get a client that comes to us that has real estate and a restaurant, we'll figure it out. But we're also going to tell them, look, we're not restaurant experts.
Yeah, it makes perfect sense. Well, that's great. I'm glad you've had a lot of success, and it sounds like you can really hone in on what investors that come to you for real estate absolutely need. And that's great. The more benefit you can provide to them, they're going to be happier. Yeah. So that's great. So tell us a little. Oh, and also before we kind of jump too far in, you're also a multifamily investor yourself.
I am, though it's kind of hard to come across non-large deals these days that make any sense. So actually, we onboarded a client relatively recently who's a big time builder in the South, and I've been having conversations with him because I'm like, I think that that's a really cool way to go. You get a lot of these mom and pops like myself who work full-time jobs, and they go, all right, I want to own real estate. So what do? I go look on the MLS, I get an agent, and anything that comes, I'm going to bid on it. But so do 50 other people. So I was like, how can I get into this area where there's not a whole lot of competition? And then I was like, oh, building could make a lot of sense. So it just seems like this big barrier. If you're like a normal person, like, oh, building a house, no way, I can buy a house. But building's a completely different beast. And what I've learned is it's actually not that challenging. I mean, it's definitely challenging, but it's not it's not as challenging as I thought. But regardless, that perceived barrier to entry, I think, means that there's a lot of opportunity there. So at least every builder I've ever talked to is absolutely killing it, which I know was not the case back in the 08-09 crisis, but at least in today's world, could be good opportunities there. So looking into that. So long story short, multifamily investor. I own a 3-unit property. I had 2. I sold 1. And I invest in a couple syndications on the LP side and on the GP side. Most of my team owns rental real estate too. So I've got 17 employees at the firm. And between all 18 of us, we have over 300 properties. So we are, I think it's a big competitive advantage. A lot of clients like talking to us because, we're not just going to BS them with all the different tax strategies they could use. Yeah, sure, you could go pay your kids, but is that actually worth your time, right? Like, we're investors too. We know that your time's valuable. Let's figure out the highest and best use strategies for you to execute on. And let's just forget all the noise. It really simplifies the conversation when you can start talking investor to investor.
Yeah, I would agree. And I trust you more,
Right.
You know what I'm doing. Yes. Or someone else on my team knows what we're doing. Yes. Yeah, absolutely.
Yeah. It's funny. Every once in a while I get like a new prospect on a sales call that I always ask, why are you leaving your current CPA? And every once in a while I'll hear somebody say, oh, my CPA told me real estate's a bad investment. I start laughing. Really? Well, that's not somebody you want to work with, right? Like,
Yep.
Yeah.
That's not really the advice you want. Yeah. Especially if you're headed down.
Confirm that real estate is a great investment. We have some extremely wealthy clients that have been in real estate their entire lives. So it's, that's actually why I started in the niche in the first place. I know that we're getting way off topic here, but
it's okay.
That's why I started the niche in the first place. I wanted to invest in real estate personally, or I was investing in real estate personally. So I also decided that I wanted to see the books and the tax returns of the people that claim real estate's so great. Just to make sure that my future plans made sense. And it does. It is great.
That is, there's something to be said about looking behind the cover, peeking behind the covers or pulling back the curtain, and the fact that you and your team see everyone's numbers. You can cut through all the, all the marketing jazz and like, what are you actually doing and how are you doing? Oh, this is how you're making all that money. Literally.
It is funny.
This is the way you save it.
It is so funny. We have a pretty powerful position, I think, in terms of figuring out the level of integrity that people actually have. I mean, we've had people that make millions of dollars with like online courses and training programs and things like that. But then where they go and actually execute what they're teaching people, they actually lose money. I mean, it's amazing.
Wow. Yeah.
I mean, we see it sometimes with wholesalers where they'll teach people how to wholesale and they make millions of like literally 7-figure incomes on these online courses
on the and education on the front end,
but then they lose money wholesaling. And it's just like, oh gosh, that's it's an interesting. Yeah.
Like, we can't say it. Let me go towards multifamily syndication. How do the syndicators look? How do the syndicators look?
Yeah. I think that the syndicators are, for the most part, in good shape. One of the biggest things that I've learned working with syndicators. So we work with the GPs and the LPs. We'll do the accounting for the GPs, the financial reporting, and the tax planning for the GPs. And then we also work with a ton of the high net worth investors that are investing in these deals.
Yep.
One of the biggest things that I've learned is, one, you have to have good financial reporting and it has to be consistent. For GPs out there, the easiest place to raise money is from people that you've already raised money from in the past. And to do that, you got to build trust. And the trust means that you give good financial reports, but you don't provide too much detail. Like, I don't need to send an investor a financial report that says, yeah, our water bill decreased by 2%, and then have them blow me up in the emails or with emails and all these questions like that. That's irrelevant. But good financial reports that are relatively transparent, that give the investors high level information they're looking for and allow them to trust you. That's one of the keys to success, I think, being a GP. And that definitely costs money. It's funny, every once in a while we get these folks that are starting up syndicates, and they've just come out with one of those syndication course trainings, and they're like, yeah, I've got a budget of $800. And we're like, yeah, it's gonna be 10 grand to work with us. Because we know how important this is. You're the fiduciary, you need to get it right, and we're going to file your tax returns on time, so none of your investors are going to be complaining to you mid-March, because we'll already be done. And so what does that mean? That whenever you go to re-raise, they'll all be right there ready to open up their pocketbooks again, which is good for you. But yeah, it's kind of resetting that expectation. But the other big thing that I've learned working with general partners and just syndicates in general is if things start going south, you've got to just blow up your investors with communications. And if you do that, you're going to be good, because your reputation is really what matters here. The investors are investing more so in you rather than the asset. I mean, a great team can turn around a bad asset, and a poor team can blow up a really good deal. But if it starts going south, you have to step up and take it on the chin, and you've got to communicate effectively and consistently with your investors. We've worked with a couple folks in the past that things start going south and they haven't communicated, and now they're wrapped up in lawsuits. So it's not a place you want to be. Not a place you want to be.
Yeah, absolutely. I think that level of communication is absolutely, it's paramount, right? Especially when we're handling people's money, we're being financial stewards, and we've got to make sure that, good times or bad times, they can get a hold of you. They know how to reach you. You're proactive. And I'm remembering an old management advice too, that through my professional career. And one of the guys goes, it's way better to, be throwing the spears than taking them. So send out your communication, nuggets, good or bad. And if they're bad, like you said, send them out much more frequently. Absolutely, man. So
it's just, for me, it's just like, if I'm an investor in your deal, I want to know the truth of what's going on at all times. And that to me is going to make me trust you. And even if we lose money on this deal, I'll probably reinvest with you because I'm not getting that experience elsewhere. Right. Yeah. Or at least I know that that's a rare experience, to get somebody that's going to be really upfront and honest with you if things start going downhill. That is great. I'm going to give that person more money, even if they lost money for me in previous. So I'm going to be mad, but I'm not going to be like, I'm going to sue you and we're going down. I'm not going to trash you online, right? And that's so important to the syndicators. And I think that a lot of these guys that do these like first deals, that again, they're coming out of the courses, it seems overwhelming to them if they're talking about losing $1 million of their investor capital. And it's just such a huge pain that they just prefer to, put their head in the sand and hope that time corrects it, but time doesn't correct it. And you've got to jump on it. And manage those communications quickly.
Yeah. Makes perfect sense. Well, any of the new passive investors or new syndicators, those are all good nuggets, what you're looking for, and then what you want to communicate as well. So steering back to, your experience here in the really as a CPA, as a professional on the tax side, I always give a disclaimer, like often and frequently, when people ask me, hey, if I invest $100,000 into a multifamily syndication with you, and you do accelerated, cost segregation study, and you accelerate the depreciation, am I going to get a win? Am I going to be able to write off some money on my, some taxes and have reduced taxable income? And I always say, like, we're going to be able to have accelerated depreciation. We're leveraging a cost seg study, so we'll do that. But your specific scenario, you need to talk to a CPA. So walk us through, just the highest level. So people that have never heard of, an accelerated depreciation, what it means, maybe the difference between straight line depreciation on a single family house and the way we do accelerated depreciation via multifamily syndication. I think that'd be a great place to start.
Sure. So to set the stage for that, back before 1986, if you were working a W-2 job, running the business, high income earner, you could invest in real estate, and the rental losses that were created, you could claim against your W-2 income. So I could just buy large rental properties, and then I could wipe out my W-2 income, which would eliminate my tax bill. A lot of physicians did this prior to 1986. In 1986, the passive activity loss rules were put in place. And the passive activity loss rules, or the passive activity rules, say that there are two types of passive activities. One, a trade or business in which you do not materially participate. Two, all rental activities. So this is where this whole rentals are passive comes from. It's section 469 of the tax code. In the early 1990s, they added an exception for real estate professionals, and we'll talk about what that means. So if all businesses in which you don't materially participate are passive, and if all rentals are passive, that means when I now go buy a rental property, the loss that's created is a passive loss. That passive loss can only offset passive income or gain on sale from a passive activity. And I can have like a rental loss from property A that's passive, a passive loss, and then it can offset the income from property B or the gain on sale from property B. That's a big misconception for some reason, but all my passive losses can offset all of my passive income. What they cannot do is offset my non-passive income.
Yeah.
So my W-2 job, my business income, that's all non-passive. So if I go out and buy a fourplex and I have a loss from that, that's passive, the loss just becomes suspended and carried forward. I can't use it against my regular income.
How about a flip single family house? That's usually like, let's say in the same year I bought it and sold it, and then that was a capital gain that I earned on that. Can I use the passive income, the passive side to, reduce that active side?
Probably not, because it depends on your involvement in the flip. And we go back to section 469 and we look at those two rules, right? The first one was,
you're not a real estate professional, then you're getting hammered. Sorry to interrupt.
Well, not yet, right? So first let's look at the flip.
Okay.
And let's ask, are we materially participating in that business activity? If we're not materially participating, meaning if I've given money and we're JVing and somebody else is going to run the deal, I probably have a passive activity that can be offset by the passive losses from my rentals.
Okay.
If I'm the one that's running the deal, then I'm materially participating, and that's a non-passive activity. So if I do the flip, I can't use my rental losses to offset the flip income.
Okay.
So rental losses are by default passive. Passive losses can only offset passive income or gain on sale from a passive activity.
Okay.
Any excess passive losses are carried forward and suspended.
Okay.
Or they're suspended and carried forward. I said that backwards. To get around the passive activity loss rules, there's a few ways. One, you can dispose of another passive activity, right? So then you can use the losses. Two, you can earn less than $150K a year, modified adjusted gross income, and you are allowed a limit up to $25,000, and that gets phased out as you get closer to 150. Most of our clients are above that. The third exception to get around the passive activity loss rules is to qualify as a real estate professional and materially participate in your rental activities. So if I have a full-time job, I cannot qualify as a real estate professional. So that's automatically out. So now all my rentals are passive, which means that if I go and place $100,000 into a syndication and I'm a limited partner, the loss that's coming back to me might be like $92,000 or $93,000 once that cost segregation study is run. And I'll explain cost seg in a second. But that $92,000 loss, while it's there, I can't use it because I have a full-time job. I'm not a real estate professional. I'm not materially participating in my rental activities. So it's a passive loss. And I'll be able to use it in the future to offset passive income or gain on sale from the disposition of a passive activity. But today I can't use it.
Yeah. Only my passive income, which is my rentals that you said you own, those properties. But my active income or my W-2 withholdings, those can't be reduced in your example that you're giving.
Exactly. So if I have, sometimes our clients that are not real estate professionals, they'll go and invest in a syndication. So they'll put $100K into it. They'll get a $92,000 loss that gets passed back to them.
Yep.
And then they'll go and sell a couple of their rentals at a gain.
Oh, nice.
That $92,000 loss can offset the gain, right? On their own rentals. So it's a good way to move money around. Like not all is lost, but if you don't have any of those other opportunities, then that $92,000 loss just becomes suspended. It sits on your tax return forever until it can be.
Oh yeah, I was about to ask. Does it ever go away?
Never goes away. Just sits on your tax returns forever until it can be used. Yeah, which
So,
provides you flexibility later on down the line. I mean, from a
few
time
years
value
later,
perspective,
I can take advantage of it.
Yep. You can sell a stake in a syndication. The syndication can liquidate, pass capital gain back to you. You could have rentals producing a gain or passive income, and that it can all tap into that suspended loss. So not all is lost. From a time value money perspective, though, we would prefer to take the entire gain, the entire loss today, so that we get the tax savings today. But again, not the worst case.
Okay. Hello. You're listening to the 5 Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review and we're going to send you a free copy. So thank you so much for subscribing to the 5 Talents Podcast. We really appreciate it. And so thank you. That's a really good explanation of why. I don't think I've heard it, that succinctly, right? And sorry for interrupting midway through it. So that's one example for not, that's not a real estate professional. How does one qualify to become a real estate professional? And, maybe even talk about strategies between a husband and wife, right?
Yeah, sure. So there's so much misinformation on this through different books, courses that we've seen. Even tax advisors are giving bad information on this. So we went and recently, early September, I think, produced a 12,000 word guide to qualifying as a real estate professional. So, so anything that you need to know about qualifying as a real estate professional is probably in that guide. It's on our website, therealestateCPA.com. You can hover over education and click the link.
What a great resource, man. That's a great resource.
Yeah, thank you. You can download a copy. It's like 35 pages or something, really good. So basically, the way that real estate professional status works. Now, we've already kind of explained why it's important to qualify as a real estate professional, but in case you haven't connected, if you're listening to this and you haven't connected the dots, if I'm a real estate professional and I invest in a syndication and that syndication passes a $92,000 loss back to me, I can claim that against my W-2 income, or my business income, or my spouse's W-2 or business income, or my capital gain income, or any other income I have. Right?
It's up pretty fast. Yeah.
Yeah. So that $92,000 loss can easily translate into $30,000 to $40,000 in tax savings. Man. And that's why it's critical that we explore this. To qualify as a real estate professional, you have to spend 750 personal service hours in a real property trade or business in which you materially participate. You also have to spend more than half your time of personal service in a real property trade or business in which you materially participate. So the first test, 750 hours, relatively straightforward. A couple key things. Personal service hours. It's not any hours, it's personal service hours, meaning that if I'm performing investor level activities like reviewing financial reports, reviewing property manager reports, paying high level bills, that's investor level activities. That's not personal service hours. So those hours will not count towards the 750 hours. Education and research time will not count towards the 750 hours because that's to be personal service hours. And a way to think about this, a good litmus test is if the hours that you are logging do not enhance or improve the property's operations, then those hours do not count. So if your property would have continued to collect rent, if the bills would have continued to be paid, then your hours don't count. If you don't have a property manager because you're not you're not doing the hours anymore, then those hours obviously count, because then there's no rent collected, there's no bills paid. So property management type hours are going to count. Acquisition hours are going to count. Coordinating with tenants are going to count. But really critical, because we've seen a lot of high net worth individuals that want to offset their taxes. And so they go, well, I'm just going to record, 400 hours of education and research. And we're like, that's not going to fly. It's never going to fly. And there's tons of tax court cases that will tell you that.
Yeah.
So the second test is more than half your time in a real property trade or business in which you materially participate. And that immediately kicks out all the full-time W-2 job people and most of the part-time W-2 job people. So if I have a full-time job, 2,000 hours a year, then I have to work an additional 2,001 hours in real estate.
Yeah.
Right? That's hard to do.
Yeah.
The more than half my time has to be in real estate. So 2,001 hours. If I'm working like a 900-hour part-time job, or I've got a part-time business, okay, I can probably prove that. And it's not, what we like to caveat here is say, especially with the full-time folks, because we get people that are like, well, I can work 4,000 hours for the year. And like, look, I'm not doubting that, right? I'm not saying that it's not impossible to do, but you're going to have to convince a tax court judge who, in their mind, they're never going to be able to understand how you can work 4,000 hours for the entire year. I mean, it's going to be a very big hurdle for them to get over. And so the big question is going to be, are you a credible person? The IRS is going to attack your credibility. That's their approach. And the tax court's going to assess, are you a credible person? So how are you going to be able to credibly prove that you spent 4,000 hours in real estate? So those are the two tests. If you qualify as a real estate professional, now you've overcome the presumption that your rentals are by default passive. Then have to show that you materially participated in your rental activities. So, and that's a whole separate set of tests. But basically, you just have to have exposure to managing rentals. You have to be, part of the acquisition, part of the actual property management, and part of the disposition if you're doing a lot of dispositions. But you don't have to focus on rentals. Right. So the reason that whole rental material participation piece exists is I could be a full-time real estate agent and I'm going to hit my 750 hours, also more than half of my time. So I'm going to be a real estate professional. But if I don't also materially participate in my rentals, then my rentals are still passive. So I have to be a full-time agent and materially participate in my rentals, which is, again, a separate set of tests.
Yeah. I'm ready to look for the guide so that I can just forward people and say, hey, how do I qualify? Read this, because there's a lot of information there. But that makes a lot of sense. Personal service, you got to materially participate. And so, it goes without saying, you don't want to get in front of any credibility check with any governing body about this stuff. So make sure you're following the rules, right? And so for the people that are investing in syndications, the question is, well, how are you going to get personal service hours and material participation in your rental activities? How are you going to demonstrate that if you're investing passively in syndicates? And the answer is, you're not going to be able to. There's just no way. You've either got to be on the GP side, or you have to build your own rental portfolio out to log hours on your own rental portfolio. So that's what a lot of our clients will do. They'll build out their own rental portfolio. They'll hit their real estate professional hours. They'll be able to show that they materially participate in their rental activities. And then they'll go place syndication investments to accelerate the losses that they'll be able to, that they can claim. Because you can group all of those into one rental activity. So it's a really cool strategy, but it takes some time to build up, and you do have to start with your own rental portfolio. And sometimes our high net worth folks are like, yeah, no thanks, I don't want to manage my own rentals. And we're like, well, then you can't tax benefits of the losses. Yep. And this is where husband and wife teams do make a lot of sense.
100%.
If one of them is a ultra high net worth or high W-2 earner or something like that, and husband and wife, one of them is a real estate professional. Yes.
Oh, 100%. One of the first things that we'll ask people is your spouse interested in real estate? And if
not,
we were to
not
show
if
your
she's
spouse,
a real estate professional, but is she interested in doing this?
Exactly. And then sometimes we get no, and we're like, okay, but what if we could save you $200,000 in taxes?
Yeah.
Oh yeah. No.
She may be interested.
Yeah. So definitely. So you can have you can earn $1 million. Working a W-2 or full-time business owner, and your spouse could be a homemaker, And once you start investing in real estate, your spouse can run all of that. Your spouse can qualify as real estate professional. The losses that come from your rental portfolio at that point can then offset your $1 million of W-2 or business income. So 100% legitimate strategy is something that we deploy a lot.
One of my first really good years in real estate tax, losses or write-offs or whatever, was I was earning as a high W-2 professional on this side. My wife was the real estate professional. We had a portfolio kind of like you're talking about, and we had probably like $70,000 of depreciation or losses in our K1s. And so I got to offset, my W-2 because my wife was the professional. But when we think about it, man, it's like she was working a full-time job before she changed over to be a real estate professional. And we made more money, this way, using this strategy where she was the pro in the family for a little while. So.
Yeah, definitely. Yeah. It's always a fun conversation to have when it's like, well, we can save you $70,000 in taxes, and a pre-tax income on that's like $300K W-2 or something. I mean, effectively, you're now working a $300K W-2 job if you're able to eliminate those taxes, right?
Golly.
So yeah, it's just it's a fun conversation to have. Absolutely.
Yeah. And so the best strategies that you've seen on your side to really work the multifamily, the syndications, we just talked about it, right? You see all the numbers, you see all the dollars. What are those best strategies that you see that you've experienced and you're like, man, this is what I'm going to go do, or this is how I advise my clients today?
Yeah. So I think it depends a lot on where you're at in life and what exactly you're doing. If you're a GP in a syndication, then every single syndication should be running a cost segregation study. We've talked to people that have said, well, none of my investors can use it. It's like, it doesn't matter, because you might have that one investor that actually can, and that's worth it for the cost seg study in and of itself. So the general partners need to always run cost seg studies. They need to typically elect out of the business interest limitations, which we don't need to go into, but the cost segregation study, what that is going to do. So when I buy property, any type of rental property, I depreciate that property over 27 and a half years, unless it's commercial property, and then I depreciate it longer. But any type of residential real property, I'm going to depreciate over 27 and a half years. A cost segregation study is the practice of looking at that asset and basically allocating the purchase price to 5, 7, and 15-year components, as well as 27 and a half year components. The reason that I do that is when I buy a 300-unit apartment complex, I've got a lot of appliances and carpet and things in there that are not going to last 27 and a half years. So the cost segregation study is the practice of identifying those items and saying, these are not going to last 27 and a half years. This bucket's going to last 5, this bucket's going to last 7, and then this bucket's only going to last 15. But the nice thing, if you pair a cost segregation study with 100% bonus depreciation coming out of the 2017 Tax Cuts and Jobs Act, we can now 100% bonus depreciate any component with a useful life of less than 20 years. So when we were talking about, you invest $100,000, you get a $92,000 loss.
Yeah.
What that's really coming from is if I buy a $10 million property and I raise $3 million, let's say I raise $3.2 million in capital to buy that $10 million property.
Sure.
I run a cost segregation study. I get a $3 million first year bonus depreciation, which creates a $3 million loss. I get to wipe out $3 million. I get to pass a $3 million loss back to all my investors, and they're left with a $200K aggregate capital account at that point, which is kind of how we get to that $92,000 number. Really nice way to push the passive losses. And especially if you can claim those passive losses, now you're rocking and rolling. So that's the real big one for anybody that's doing a GP or thinking about syndication. If you're on the GP side, you've always got a cost seg. If you're on the LP side, it's more about just timing. You know that these guys are going to cost seg. You know that you're going to get a passive loss passed back to you. The question is, how can you best utilize that loss? And does it make sense to invest today, or does it make sense to invest in January or February of next year based on what activity you have going on? Maybe I've got a stake in a private business that's going to liquidate, and it's going to create a large passive income or passive gain for me. I'm assuming that I am passive in that. Well, I might go and invest in a couple syndicates at the same time or during the same calendar year to create losses to offset that. So a lot of timing considerations that need to be explored, or just start building out your own real estate portfolio to go after that real estate professional status.
Yeah, that's those are awesome nuggets, right? I think most people don't realize that I talk to when they're if they're investing $100,000 and they do those cost seg studies, and it sounds like the number that you keep giving is like a standard kind of, just general number you see often. Is that right?
We see it often. I mean, after the 2017 Tax Cuts and Jobs Act, basically for every $1 that you put into a syndication, you can generally expect an 80 cents to 95 cents loss passed back to you. Wow. Some of these guys are able to clear 100%. So, in that example where I raised $3.2 million of investor capital, I do a cost segregation study that actually generates a $350K loss. Yep. So I wipe out my entire $3.2 million aggregate limited partner capital account. And that means that if you invested in my deal, then you put 100K in, you get 100K back in terms of a loss. And then the excess loss is typically allocated to the general partners, which is also a fun conversation to have. But because these guys don't put any money in, but then they get to claim a tax loss if they've structured it correctly. Yeah. But yeah, so anywhere between 80 to 95% is what you can kind of expect to get back in terms of a passive loss. I guess I should caveat that though, because this is coming from depreciation. When this syndication sells, you have to recapture that loss. You have to recapture that depreciation that was claimed. So sometimes
it's going to hit you somewhere, right?
Yeah. It's not this like beautiful tax shelter that you never get to, you never have to actually pay up. So you do have to pay up, which is why it exists, right? If you didn't have to pay up, this thing would not exist. But yeah, so at some later point, you're going to have to pay the taxes on the gain, and you need to be aware of that, because in 5 to 7 years, when this syndication liquidates, you want to be ready. You want to have the cash on hand to pay the tax.
Yeah. Also on that last point, right? So most people don't know it's there. Thank you very much for the knowledge and the insight of you can take it. And here's the difference of being a real estate professional and not. And so that was a beautiful explanation. And then the amounts are good examples. So people realize, if I put 100K in, man, I'm trying to have depreciation or losses almost equal to my investment amount. So my return that I'm getting, is really like, you can almost consider it as like complete upside, or at least the taxes are complete upside, which is awesome. Now on the last kind of thing that you mentioned, right, which is I'm trying to figure out the best strategy. I've got my nut back. I have it in hand. I'm going to get hit with taxes. Would it be a good idea to put that money back into another deal that has cost segregation in the same year that, we went full cycle, we sold, I had all my money back, instead of spending it, I put it in another deal? How does that work?
100%. As long as you want to continue acquiring real estate or continue taking stakes in real estate deals, then you can very, very much so kick the can down the road for a long time. And the time value of money of something like that is huge, or I guess the net present value of that type of a scenario is huge. So yeah, so if I liquidate, or if the syndication liquidates, and let's say that I took a $90,000 loss on my 100K, and on top of that, I get a 150K back. So I've got a 50K gain on top of that. Well, really, I've got a $90,000 loss that I claim that I have to recapture.
Yep.
That's my new 50K gain from investing in this syndication. So I've got a total 140K gain whenever the syndication liquidates. I've got to pay tax on that 140K gain, or I can take the money and I can invest in a new syndication. I can create another set of passive losses that is another 90K, or maybe I invest 200K this time and I get 180K of losses, and I completely wipe that gain out. So yes, you can definitely layer it. It's a big timing consideration.
Yeah.
That's how we help a lot of our limited partners out. These guys that don't necessarily have time to go build out their own real estate portfolio, they're never going to qualify as a real estate professional. There's a couple strategies that we can run there, but most of the time it's pointed at the timing over the next 5 to 7 years of investing in syndications and when we expect them to liquidate.
Yep. And I have people, when I explain this, they go, "Oh, it's like 1031." And I go, "Well, no, it's not like 1031 at all, but it does help you avoid your taxes, like 1031, if you want to
Right.
consider it like that. But
yeah, not a 1031, but kind of the same, similar tax impacts. Yeah.
Yeah. Your best advice for the limited partners that are looking at syndications in terms of their tax losses, in terms of what you see, what last, nuggets can you provide here?
Yeah, I think that we covered a lot with the tax losses. Again, the question is, the losses coming out of the syndication for you will always be passive unless you create your own rental portfolio to recharacterize those losses as non-passive. So the question is, if you don't create that rental portfolio, can you claim the losses? And that's when you have to look at your situation globally. You have to understand what your goals are for the next 5 to 10 years. What are you going to start investing in today so that as you continue to accumulate these losses, you can create the passive income in addition to that you don't pay tax on for a long time because of the losses that you've created. So it's really just kind of an understanding of how to layer everything. But the biggest thing for limited partners, for myself too, that at least the rules that I follow is you're very much so investing in the person more so than the asset. I have seen really great syndication teams make gold out of a deal that you thought was doomed from the get-go. I've also seen really bad syndication teams trash a home run. And you just have to make sure that you do your due diligence, that you're going to get somebody that is going to have a high level of integrity. They're going to communicate problems to you as we go. We've got exit plans in case it goes south. You've got to do your due diligence.
Yeah. And anybody that wants some more nuggets on that, we also wrote up an ebook on our website. So you can go hit that. And there's like a 65-page guide on, your due diligence, passive investing versus active investing, really working through, some of the questions you need to ask your general partners and teams and, that
Nice.
type of thing. So yeah,
Nice.
that's on that one. During COVID, we had some extra time. So we thought we'd put it together. Man.
That's great. I'm actually going to write that down. I might reach out to you later for that.
Yeah. Our website's 5tcre.com/ebook, and you can go register there and grab yourself a free ebook on it. And excuse the grammatical errors. This is the first time I actually try to write something. And well, cool, man. This has been really great, Brandon. I really appreciate the time, your expertise. If people, investors, limited, active, want to get in your world and they want, to sit down with your team of experts that own 300 properties that can help advise them on their best situation, the best strategy for the future, where do they reach out to you?
So you can go to www.therealestatecpa.com. That's our website. We've got a lot of educational content on it, a lot of guides, podcasts, all sorts of fun stuff there. You can also click that big orange Become a Client button if you want to explore a relationship. If you want to connect with me personally, the best way to do that is LinkedIn. So you can just either Google or go to LinkedIn and search Brandon Hall CPA, and I should pop right up.
Yeah, that's awesome. Thank you very much. And the strategy part is key. Talk to them now, sooner than later. So one of the trends that I kept hearing was you don't talk to him at the end of the year when everything's done. I would talk to him early, so that way you can project or, just provide a strategy. They can help you determine what's the best plays. And even if it's not now, it's in the future. I think, you and your team will definitely be able to help guide people through what's the best plays here. So that's awesome.
Yeah, definitely. Yep. Feel free to reach out.
Well, very good. Well, my name's Abel Pacheco. I'm your host of the 5 Talents Podcast. You can reach out to us at 5tcre.com, where we've got these podcasts, multiple education points, books, things like that. You can download. And it's been a pleasure. Brandon, is there anything else that we didn't talk about, anything we didn't touch that you really want to highlight before we go, man?
If you are investing in real estate and you're working a full-time job or running a business and you've just listened to this podcast, you've done the research, you realize that the losses that you create from your rental activities are going to be passive and you can't claim them, but you still want to do something today to reduce your taxes. What you can do is invest in short-term rentals like Airbnb and VRBO properties. And when your rental period per tenant is less than 7 days on average, you do not have a rental activity per section 469 of the code. So that was what we were kind of discussing earlier in this episode, which means you don't have to qualify as a real estate professional to take your losses. You just have to materially participate in the activity. And there are 7 tests for material participation. We're not going to go through all of them, and I didn't want to, but the lowest bar is that you complete substantially all of the activity, which means that you don't have a property manager. So if you buy a beach home in October and you self-manage it, you book all the tenants and everything through the end of the year, likely you will have materially participated. You can then run a cost segregation study on that property, and you can take the losses as non-passive while working a full-time job and not having to worry about real estate professional status.
It's great nugget. Thank you very much. And I have a feeling we'll have more than a few people reach out to you for your services. And thank you very much for all of your time.
Absolutely. Thanks for having me on.
All right. Thank you, everyone. Bye-bye. Thank you for listening to this episode of the 5 Talents Podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who followed their dreams and achieved massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents Podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked. Tell us your favorite guest. Give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents Podcast.